Hello. Jean-François.
Hi.
Nice to meet you.
Gabriel.
Nice to meet you.
Charles.
Bonjour.
Nick.
La souris,
There.
ça serait de la
Donc, bonjour et bienvenue au revêtement de marché. Préférez-vous les instructions en français? Do you prefer the instructions in English?
English, please.
Each team has 20 minutes to present its case to the judges. I will show a board for the last 10, 5, 2 minutes, and the last 30 seconds. During the last 10 seconds of the speech, I will indicate by the means of my two hands the number of remaining seconds. A team not having ended its presentation after 20 minutes will be stopped to move on to the period of questions. The period of questions of maximum duration of 5 minutes is assigned to the jury at the end of the presentation. I would like to remind to each judge that it's mandatory to ask at least one question during this period. Please note that you cannot reveal the name or source of your university, as you may be disqualified. Also, I would like to ask the public to turn off the ringing on their cell phone. I will now invite the judges to introduce themselves. Je vais maintenant laisser les juges se présenter et ensuite vous pouvez démarrer votre présentation.
Hello. My name is Jean-François Girard. I'm a portfolio manager at Desjardins Securities. In the team, I'm involved in the asset management and the wealth management for the clients.
Hi, my name is Pierre Lacroix, Desjardins Securities, same team with Jean-François, Portfolio Manager. We manage assets for individual, institutional, directly into stocks and bonds globally, and we're a team of 12 to do that.
My name is Nicolas Harvey-Girard. I'm working in the team since 2016. I'm in the team of the stock analyst, as a stock analyst, and a trader.
Thank you.
Bon après-midi, messieurs les juges. D'abord, merci beaucoup de nous avoir donné ce mandat de vous aider avec le futur pour notre client, Monsieur Apoutre. On est très content de savoir cela. Évidemment, on sait que ce client est assez important avec les changements récents qui sont passés dans votre firme. Un nouveau courtier, on croit que c'est une opportunité fantastique de renouveler notre relation avec les clients, puis vraiment de bâtir un solide futur pour celui-ci alors qu'il va prendre sa retraite. Comme on va le présenter aujourd'hui, d'abord, on va analyser un peu sa compagnie. On sait qu'il y a une exposition qui est très très forte à sa compagnie, puis à l'industrie qui est reliée à ça. D'ailleurs, aussi, on a fait une analyse au niveau de la valuation de la compagnie, afin de vraiment être en mesure d'avoir une meilleure perspective sur ses investissements, autant dans la compagnie que dans la diversification, alors qu'on va de l'avant. D'ailleurs, les éléments qu'on va d'abord établir via l'évaluation de la compagnie vont ensuite nous permettre d'avoir une formule d'investissement pour lui dans le futur, comme on va voir, qui considère autant les risques auxquels il est exposé que de satisfaire les besoins en capitaux que les besoins alors qu'il passe à la retraite. Donc, mon équipe de moi-même, Hugo, Gabriel et Charles, on est très heureux de vous présenter notre site.
So to begin, we'd like to briefly introduce Mr. Laportier and also the company Deluxe Metals. So for our client, he is currently the CEO of Deluxe Metals and is planning to retire in 2 years. What is happening now is he has a 10% stake in the company and also values controlled risk and also visibility. As for the company's Deluxe Metals, it is currently facing competitive pressures from in the industry, and the growth rate is planning to be around 3 to 5%. The company actually specializes in aluminum processing and is currently sitting at a market cap at $281 million. So with a deeper look into the company, we can see that with this geographic sales breakdown, it's 50% in the United States and over 35% in the NAFTA countries, and therefore we do see the risk that's posed to the company is that it is overly exposed to South America and NAFTA, and also with the company is that it is in a highly cyclical industry, and therefore also poses a significant risk to the price risk of aluminum. So as for the company, further breaking down into looking at their profits and liquidity, we decided for profits to look into their return on sales and return on assets. and also look into their gross profits. And in terms of liquidity, we decided to take the current and cash ratio. And from what it seems is they are relatively liquid with increasing current and cash ratios, showing that they have a lot of assets readily available. But however, looking on their return on sales and return on assets, it's evident that their profitability is quite unsteady and is unpredictable, especially right now with their slowing growth and with the prices expected to be fluctuating with their competitors coming in. It is seen that their in terms of their profitability is going to be unstable for the years to come. And furthermore, by breaking down into their debt and equity analysis, it is evident with their debt ratios from debt to equity that they usually do have a stable flow of debt. However, looking at their cash flows to debt ratio, it's evident that it's also unstable. And in terms of interest coverage, that they're usually able to pay off their interest. And for return on equity, it's also unstable. So what we can really see for Deluxe Metals is that with the changing in the industry and their changing of their company, it's evident that that they are their cash flows are unstable for the years to come, and that's a risk that our clients should take into consideration.
All right, thank you, Gabby. So looking forward, we've established a few things from how the market perceives Deluxe Metals. A few things that must be understood, evidently, as my colleague has said, is the nature of the cash flows, which are very unstable. From year to year, there's a lot of variation, and that impacts how the company is perceived by the markets. Although your clients definitely, he says, he has a lot of control, something that's very stable, numbers show otherwise, and that's something that we'll have to consider going forward. Among a few evaluation methods which we've considered, the one that appears to be the most consistent and the fairest was to do a multiples method. And among the multiple metrics which we've observed, the one that seemed to be the most consistent in the past as a valuation for the price of the company was the shareholder equity per share. For that, evidently, we've adjusted the market cap of the company. In the past, we know there's been a lot of share buybacks and dividends, so that was taken into account. We can walk you through the exact calculations in the question and answer period if you guys are interested in. Specifically, the ratio which we're looking at today is a multiple of $14 per share in terms of shareholder equity. If we base this and project this forward, we see that by the end of 2017, we should expect a price of approximately $8 and $8.50 by the end of, there's a gap of 1 year. So 2018 and 2019, we have here the price targets. Another metric which we've seen is kind of goes along the same arguments we've made earlier of unstable cash flows and revenues, which contrarily to what your client believes is the state of his company, we see that the markets see a lot of volatility and see this, and that is translated in the options prices, which imply pretty high implied volatilities, which evidently is a threat to someone who's entering retirement. So evidently that highlights the need for hedging and clearly something, a strategy that shows more diversification going forward.
Okay, so in terms of our client's investment policy, we first looked into his expenditures expected in his retirement. For his first 3 years, he is expecting to spend around $1 million, and then for the next 10 years he plans to spend and decrease that by half to $500,000. And for carrying on into his life, he plans to spend around $250,000. With an income of $450,000 for the next coming 2 years, it is evident that he does have quite a high need for his future retirement purposes, and therefore really needs to focus on reallocating his portfolio in order to sustain those needs. And so that's why with our investment policy, our performance objective is a capital preservation strategy. We want to ensure that he has around a steady 3 to 4% in terms of returns to allow him to support his lifestyle in Florida. And therefore, with his investment horizon of around 30 years post-retirement and the liquidity needs we demonstrated in the previous slide, we do want to keep in mind and that his constraint is that he wishes to keep a portion of his wealth in DLM shares. And with his risk tolerance level, it's obvious that he's towards the conservative side, and this is why we propose the following strategy that my colleague Charles will introduce.
All right, so before diving into the actual changes to the portfolio that we want to bring for Mr. Naput, we're just going to wrap up with basically the conclusion of our analysis when it comes to deciding how we're going to tailor his portfolio, given the fact that right now he only owns the stock of his own company. So Mr. Naput, it's no secret, feels much more comfortable only owning the stock of DLM. The problem with that is that he doesn't get any benefit whatsoever from diversification. The other thing that's very dangerous with such an allocation is that when you only own that one stock, you're very much exposed to the fluctuations in the sector in general. If prices of the inputs go up, your company might not do well, and the stock you own might not do well either. So it's a double risk in that way. So for this reason, we will completely re-examine the allocation of the portfolio. So currently, around 75% of Mr. Naput's wealth is in DLM shares. As we said, this is way too much. And the points to consider here as well is the fixed income. Right now it's all in government securities with an average duration of 12 years. We will speak later on as to why we think this is too high a duration and why this allocation of the asset classes is not necessarily optimal. So, how will we change as a whole the portfolio? The first mandate that we have and that we think is reasonable is to significantly lower the risk of the portfolio. Right now, by only having one stock, Mr. Naput is basically writing the stock of DLM, writing the stock of his own company. So we want to lower that and be in the low risk, low return type of environment that will sustain him in his retirement. This also makes a lot of sense given the fact that he already has $28 million of net worth. So a low return can very much sustain his lifestyle post-retirement. And finally, in terms of asset class, we want to drastically shift this allocation. Right now, he's about 25% equities and the remainder in fixed income. We want to switch that around. We know that he wants to keep DLM shares because, after all, it's his company, it's his little baby. We're fine with that, but we have to trim it down significantly. So we're going to go for a 70% fixed income, which is very safe. 20% broad-based equities, we're going to dig deeper into that in a few minutes, and 10% DLM shares. All of this, a total of which is 28 million. So, for the fixed income, so the 70, 75%-ish percent of his portfolio, we want to go with 60% government, high-quality corporate securities, and 40% government. What we're really going for here is mostly just ETFs that are well diversified, super low expense, and will give you that nice little coupon either every month or every 6 months, depending on the nature of the ETF. So really here we're emphasizing the capital preservation part of the strategy. On top of that, second mandate, we want to lower the average duration of the fixed income portfolio. So here with an environment with rising interest rates, both in Canada and the US, we think that it's fair to lower that duration to at least slash it in half, so from 12 to 6 at the minimum, to not be basically injured by these rising interest rates. For the equities, so the 25% remaining for the equities, we thought that it would be optimal to be basically just like an index, be well diversified, be like the broad market, but tailor it slightly depending on the sectors, so that you're less exposed to risk that would also affect his companies. So the point is, we want to be relatively close to the S&P 500, which is in gray bars, but tailor it slightly. For example, we want a higher allocation to consumers because it's very stable, it provides better cash flows in times of uncertainty, and that is going against the nature of his cyclical company, which is in the materials industrial space. We want to be a bit more exposed to materials as well compared to the S&P, because we want to capture that return in case materials are doing well, but the input of your company are getting pricier. That's something you might want to capture. Finally, we also went with a bit more in real estate and utilities. Again, stable cash flows, something that's recurring, something that's safe, something that's low volatility, and just better fitted for Mr. Lapoute overall. So this allocation for the 20-25% of equities that we suggest has a target return of 5 to 7%. It's not that high, but it will provide more than enough to boost our portfolio's return during the next 30 years to allow him to get those expenditures post-retirement in Florida. So
finally, although Deluxe Metals, as we've seen before, is liquid and very profitable, the problem is that with the slowing growth and competitive pressures it faces in its industry, we do have a concern for Mr. Lapoute in how he diversifies his portfolio. And we really do stress that he needs to diversify more. And in that case, with Charles' explanation of the weight allocations, we would like to adjust the weights to include more different industries to hedge, to essentially mitigate the risk of the cyclical industry there is in aluminum processing. And with that,
yes, evidently, like we've talked, it's the big rebalancing. He has a big exposure to his company. So moving forward, we understand he has a very sentimental attachment to what he's doing, but as he's moving to retirement, maybe that feeling of control, he's going to lose that. Maybe we can play a bit on it. Maybe it's an opportunity for us to really play on the fact that he's moving with a new counselor, someone who can explain to him truly what the financial implications of his portfolio are, rather than the simple friendship that he had with his previous portfolio manager. Also, as we're moving into an era where we know the prices of the market are pretty high, again, the strategies that we've proposed today will really provide him a hedge on both market downturns, which would both affect his portfolio of a diversified stock portfolio, but also the company itself. So that being said, we are happy to close this presentation, and we open the floor to questions.
I would like to get more information about the valuation of the company, because I think you use forward P as your way to evaluate the business. Did you look at anything else to help the client understand what may be the value that he may left on the table, or you're really comfortable with your evaluation at the moment?
We've checked a few other multiples. So in terms of multiple, the lowest range was probably at $7, which is the current price. And the one we've had is definitely something that's more optimistic. If we could,
yeah, we can go back.
In terms of what exactly has been said, one of the things that's really a defining factor in the valuation, and we've noticed that the market appears to see that, is that the assets do not seem to lose value. So although revenues and those kind of things might fluctuate a lot, it's the asset that is the principal metric by which the market values it. So we feel that even in the downturns, there might be a floor to the valuation of the company, because over 2/3 of the market cap is in hard assets. There are obviously other things that might be considered. We know that the revenues going forward might be harder. We know that with the protectionism era that is currently forming, we know the government in the United States, which, although we might have the tax incentive that we've had this year, maybe it won't be a thing in the future. So evidently the revenues were something that we felt were not as relevant in really having a fair valuation of the company. So that's really why we went for an asset-based valuation.
If I may, I'd like a little perspective onto that. Regardless of the conclusion of the valuation, we felt that it was highly inappropriate to only have one stock, right? It's only, you cannot just own the stock of your own company. It's really not the best way to create risk-adjusted returns. So even after looking at different types of valuation, we really felt that, yes, he might be, to use your own words, he might be letting money on the table, but even at that point, there's just so much risk in only owning one stock that even if you find that the company is greatly undervalued, you still have to diversify.
Okay. Even if you pay high tax on the asset you have now, did you consider any tax implication in your decision, or?
Not indirectly in the direct sell of, like, if we're thinking about the capital gains on the assets you would. One of the things which was hard to quantify, evidently he has grown the business tremendously himself, but at what price he definitely owned those assets. And again, if he's not, maybe he would have to incur the capital goods tax right now, but one, if he's moving to the United States, I don't think we know that capital gains tax there are lower, so in the future, he would have to incur those, but if he incurred those on the new assets which he would hold in the future, it would be relatively safe to think that the overall tax rate overall taxes that he would pay over his lifetime might be lower. And again, in terms of diversification, it's something that we feel really sufficiently mitigates the risk associated with really holding only one stock.
Yeah, I was still on the impression as well on the valuation side that, you know, I have a little bit of pushback there because I can see the ROE going up like significantly in the next couple of years in your charts, while, you know, the shareholder price or the shareholder price per share, as you put it, or the book value, is kind of steady. So I was a little bit kind of wondering about, you know, why it's happening. And how do you feel the valuation should be linked to this this kind of situation where you have a very good improvement on that side? Can you explain a little bit on how do you derive your book value per share and why you?
Sure. So evidently we came up with a raw shareholder value which was pretty consistent over the years. Evidently, we had to adjust for the PPE, the depreciation, but that again was relatively easy to model in the sense that it's pretty consistent, and just adding back the depreciation gives you a good idea of what the shareholder equity is worth. One thing which we've noticed, evidently, the prices are given that there's no dividends or share buybacks, which there was a lot in the past. So evidently, the creation of value was consistent over the years, and that the fact that they are able to generate dividends and be able to buy back shares is an indication that they have the steady cash flows as their assets. Again, this is the main point on which we made the valuation, because we felt it was the best metric by which the market saw it. So we kind of reverse engineered it to find in the past what was the shareholder equity adjusted for the dividends, and by projecting it further, we had all the information except for the
period of questions
is over.
Oh.
Can I conclude? Can I
Thank
conclude?
Yeah.
So by just finishing up the simple calculations to really figure out the shareholder equity going forward, and by reverse engineering what was happened in the year, we're able to find a pretty good multiplier of, again, the assets, which for the reasons which we've mentioned, we felt was the best metric on which to base the evaluation.
Thank you.
Thank you. Thank you. Thank you. Thank you.